Hey everybody, it's Elliott, Touchstone Financial Education. Today we are going to talk about income. But first, I'd like to say hey to all my longtime listeners and welcome to my new listeners, and hopefully you become old listeners as well. You can check us out at touchstonefinancialeducation.com. If you have any questions, shoot us an email. So, back to income. How do we generate income from a portfolio? Well, income from stocks is called dividends, dividend income. So companies will reward you for being a shareholder and they will pay you a percentage of the value of the stock itself. Usually we'll say, oh, the dividend yield or income is 2%, 3%, 4%. Generally speaking, it's more mature companies that will pay out these dividends, like big energy companies, Chevron, ExxonMobil, or you have product companies like Procter and Gamble and Clorox. So the more mature company, generally speaking, the higher the dividend they will pay out. So this is a nice way to get that income. And by the way, companies that are more mature that pay out higher dividends are less volatile in terms of stock investment. So the more mature company, the less volatile, the higher the income you can generate. So right now, for example, the Dow Jones Industrial average rate of return on a dividend, okay, is 2.91%. That means you own the stock, you'll get somewhere around 2.9% in income per year. You can go after individual stocks and obviously get much more income, but that is the average dividend yield or income from stocks on the Dow Jones Industrial Average. The S&P 500, which is more of a growth index, is a little bit lower at 1.27, but there are some stocks on the S&P 500 that pay much more than that. So you have to do your homework when you're pursuing income, just like you do when you pursue growth. So the lower the dividend yield, like on the S&P 500, more likely the greater the opportunity for growth. It's a little more volatile, and if you're interested in income right now only, you might want to look elsewhere, like on the bond market. And one thing I like to use, and I've been using for a very long time, is called Putnam Premier Income Trust. The ticker symbol is PPT or Paul Tom. And believe it or not, it generates 8+% in dividend income. And it pays out every month, which is really nice. So you know that once a month, you will get some dividends hitting your account, whether you need to live on the income or you're just going to reinvest it. It's a pretty stable investment. Like I said, I've been using it for a very long time. Market goes up, market goes down. It stays around $3.70 a share. It's fluctuated between 3 and 5 bucks over the last 20 years or so, but for the most part, it's going to stay here. So we could be here, generate income or make money in the market with our portfolio, and we'll leave the volatility to our other investments. And I say it that way because in a good asset allocation, meaning how your overall portfolio looks, all of your investments combined, you don't want all income, you don't want all growth, but that income component will add that stability. And it's nice to have those dividend yields hit that account. Again, energy company, old school product companies like Clorox, and of course, what I just mentioned, I like Paul Tom or PPT, Putnam Premier Income Trust, with that 8+ per year dividend yields, and it does pay out every month. Another way to generate income in your portfolio is through bond ownership. So a bond is just a debt. The government issues debt, companies issue debt, and as individual investors, sure, you can go out and buy individual bonds if you want to, but for the most part, bond funds, bond ETFs, mutual funds will do the job for you. We invest in bonds for that all important income as well. And right now, the benchmark for bonds, which is the 10-year Treasury, is trading a little bit below 4.5%. That means that whatever you put into the 10-year Treasury, you will earn 4.5%, a little bit less, excuse me, on your money. This also reduces the volatility in your portfolio as good bonds are less volatile than stocks. Now, bonds do fluctuate, don't get me wrong. There are some high risk bonds out there, but if you are a middle of the road investor, a good large, or excuse me, long-term bond fund or intermediate-term bond fund, as they're called, and I like those a lot right now. They will pay out decently, and it will help to reduce that volatility in your account. Whether you need to live on the income or, like I said, reinvest the interest payments from the bonds or reinvest the dividend income from the stock or stock funds, you will still do well with less volatility in your portfolio. Now, real quick, I've got to talk about taxation. I'm going to go back to dividends real quick. Guess what? It's not complicated. Dividend income taxes are 15%. That's flat. That's it. 15%. So as you pursue dividend income, know that your taxation in your brokerage account, in your taxable account, will amount to 15% of the income earned for that year. Bonds can fluctuate a little bit and also depends on whether they're tax-free bonds or U.S. Treasuries bonds issued by the federal government, or they are corporate bonds. So I'm going to leave that one off the table. But please do your homework on taxation on the bond side. Know that the dividend yield, or excuse me, dividend income tax is 15%. Both are great ways to generate income to live on, to reinvest, or just overall reduce the volatility in your portfolio. And if that doesn't tickle your fancy, if you're looking for something a little more safe and secure than that, then guess what, guys? You've got high yield savings accounts. Best way to find them: websites like NerdWallet or Bankrate provide wonderful lists for all of the best high yield savings accounts across the country. They'll tell you account minimums, etc., interest rates. There are brick and mortar banks listed. There are online banks, if you so choose, that are listed. And right now you could find 3.75% all the way up to probably 4.5% if you're looking for that all important income. And the nice thing about high yield savings accounts over and above dividend income and bond income is that the accounts are FDIC insured. So you'll generate the income with the insurance on the account. They are very stable because they are bank accounts. And again, this is another way to generate income to reduce the amount of volatility in your overall portfolio. All right, guys, thanks for listening. I'm going to keep this one kind of short today. Just remember, income can be generated in your portfolio from dividends, a reward for owning a stock or a stock fund. Bonds, you are the lender. You will generate interest income from holding those bonds. They provide some stability in your portfolio as well as the income. And then last but not least, once again, the high yield savings accounts that you can find on NerdWallet or bankrate.com to generate more than just whatever your money gets sitting in a basic savings account, or of course your checking account, which I hope you don't leave your money sitting in there. Guys, if you have any questions, please reach out to us. TouchstoneFinancialEducation.com. Shoot us an email. Check us out on Facebook and X and Instagram as well as TikTok. Thanks for listening, guys. I'll be back soon with some more information. Keep the faith. The volatility is crazy right now. Income is something that's worthwhile pursuing. Take care.